Hey everyone, cp0x podcast 17. Our guest today is Mikhail Egorov from Curve again. Hi Michael.
Hi.
And helping me today to discuss technologies around Curve is Ugvi. Hi Ugvi.
Hi.
First, I'd like to do a little shout out towards what happened. We have Michael for the second time. He's the first guest we called for a second time. For an absolutely long time, the podcast with Mikhail was the most popular of our alpha material on the channel. A little bit it was surpassed by the podcast with LlamaLend, but we have to admit that since then the channel has grown, so if we somehow normalize, it isn't known who won. And of course, we didn't miss the opportunity to call Michael again, and we thank Michael for agreeing to come on again and tell us what's going on around the Curve system, around your crypto life. The last podcast was recorded in February 2024, and we're going to try to do a little overview of what's been going on since then. We recorded the podcast just before the launch of Lend, which is now called Curve Lend.
Well, you can call it both.
Okay, tell us, Mikhail, what successes did LlamaLend achieve? Was the launch a success? Was it above or below your expectations?
Well, I would say that my expectations were probably higher, although TVL LlamaLend is probably higher now than it was at the time of its previous high. That's basically due to the fact that its TVL has mutually increased resupply. Perhaps we should, so to speak, thank this project in this regard. Reversible liquidations work too, as intended, but now really work is being done to simplify the LlamaLend for users. Because it turned out that now the new users who came into crypto are not as literate as the first DeFi users, of course.
But before we go to simplifications, we're still going to do some explaining for those for whom this podcast is a first. Can you tell me, please, what is the innovation of LlamaLend and what is it?
The main innovation is how the liquidation mechanism in LlamaLend works. First, when the liquidation price reaches the liquidations, firstly is smooth and secondly, more importantly, reversible. That is, if the price of some asset descends below the liquidation price, it starts to convert into stablecoin smoothly. This stablecoin which it has converted does not extinguish the debt necessarily immediately, but it still is on the borrower's account. Why is it there? Because if suddenly this collateral starts to go up in price, then the stablecoin is converted back into this collateral. And as a result, if there is a drawdown because of some events like the war in the Middle East, it turns out that the borrower did not lose his entire position or even lost 10%, but lost maybe 1-2% of his position. This is at least what I see in real observations. But the borrower is still to observe his own position, because if he is a long time below the liquidation price, then his health will come to an end. And it can be raised by paying a small part of the debt. But if he doesn't absolutely follow, then he could be liquidated altogether. For example, I have observed one position just in the last few days. Someone borrowed $500,000 on the CRV and disappeared for 3 weeks for some reason. No transactions at all, he didn't show up, nothing. And meanwhile, the price of crypto, thanks to events in the Middle East, fell, but the algorithm valiantly protected his position below the liquidation price for a couple of weeks, but then it was no longer healthy enough and it's still liquidated. Because this is not an infinite resource, so to speak. If someone overslept, or even for a few days overslept, or even for a week overslept, he still has a position alive, even though all the prices out there are below his liquidation. In principle, what was intended for LlamaLend is quite working.
So I want to dive a little bit inward here, the question that I think everyone always has when they face with LlamaLend. The first question is this: is there some course where the price would fall to liquidate you completely?
There is no such course. The liquidation doesn't happen at any price. What happens is that once you are below the liquidation price, you have this conversion and deposit mechanism, but it has some losses. We can compare those losses to funding or to health in some games. That is, you have some health, and as soon as you get underwater, you start losing health. So you become a scuba diver who has oxygen, and this oxygen may run out, but it's still there. Rather, it's liquidated when you run out of oxygen if you're underwater at that time.
What's going on under the skin in this thing? Who is this money going to?
They actually go to the arbitrageurs, for example. Because these exchanges back and forth, they're not 100% effective, they absolutely naturally cause some losses. And despite the fact that the commission goes to the borrower from these exchanges, still arbitrageurs earn something. There is also in principle a volatility decay, that is breakdown due to volatility, so it basically leaves that money to the market. And the greater the volatility, the faster the rate of loss of health. If suddenly you are underwater and the market suddenly goes quiet, the losses will be very small. If the market is shaking, you need to look after your health, but the losses will still be less than with typical loans.
I understand correctly that there are edge cases when part of the collateral is realized in dollar stablecoin and then bought back when the price of the collateral rises, and if suddenly in the market conditions are unsuitable, that the price somehow oscillates around this edge value, then you can in theory this edge value is a little bit more losses due to the conversion of collateral back and forth.
Yeah, of course, if you have a lot of volatility, if the market is shaking and you're underwater, then you'll have more losses. But if the market is shaking when the price of collateral is higher than the price of your liquidation, then of course you will not have additional losses. In normal lending, if you're below the liquidation price, then your collateral is completely or partially lost. And on the LlamaLend, if you're below the liquidation price, your collateral isn't lost, but you have an accelerated rate of loss. It's not just the interest on your loan, but there's also this here volatility loss.
It's also interesting to know in a year of observing maybe users, were there any such unpleasant cases, or did everything work off well and even the worst case scenario turned out to be better than a complete liquidation?
I can say that there are cases that are unpleasant for the system, or rather for certain markets. The fact is that market markets are isolated from each other. If something happens to one market, it doesn't affect other markets in any way. Where everyone can use the market with any collateral they really like. And users need to look at what collateral they're lending against. So for example, a market was made with collateral for the token UVU, and this token UVU accordingly didn't have particularly high liquidity or particularly high demand. Ideally, the market for such tokens should not become too large because this conversion can put more pressure on the price than there is demand. This is something that should not be allowed. These cases are bad for the system, and this, I would say, is the most tricky thing, that where you have to look at what you give as collateral money, necessarily like. If, of course, you pledge money for Bitcoin, for Ether, some tokenization, then everything is okay, there is enough liquidity there. But if you pledge for some little known coin, then you need to think hard whether it is worth it or not. As a rule, they pay more interest there, because the risk is higher there. And one more thing, actually, is why we decided to make the interface a little bit easier for users. Many people do not really understand this mechanism, that there is no price at which, in fact, there will be a complete liquidation, that it happens when the health turns out zero. Many also ask what happened from my position if this liquidation occurred. People don't really understand how this works, because it doesn't work the same way as a normal lending protocol. So you have to bring that to them somehow in the interface.
Then it is appropriate, I think, to ask the question, who can create markets on LlamaLend?
In principle, absolutely anyone can create a market. But in order for these marketplaces to create some incentives for loans with cp0x, so that people pour Curve USD there, it is necessary to create a vote, which will be approved by DAO. If the DAO doesn't approve, then the market, of course, exists. Anyone can add money to it, but there won't be any incentives on it. Now it works like this.
And the second question, I wanted to ask, when liquidity was low, who bears the risks here? I mean, how isolated are these markets?
The risks here are borne, I would say, only by those who lend in this market, only in this market. So those who lend against UVO, for example, they bear the risks in this case.
We borrow in these cases always Vyper USD?
Yes, the way it's done so far, that it's always Vyper USD does the borrowing.
And Vyper USD does not bear any risks here?
Absolutely no risks it bears, because this is added not in the mint market of Vyper USD, but this is added as a lending. Everyone who brought Vyper USD there and bear those risks, so to speak.
I think that's important to discuss, because always when you're using these kinds of market, you always want to understand where you can get hurt.
Yes, we made everything isolated on purpose, so that if someone borrowed under some strange coin or something they himself maybe even do, that it had absolutely no effect on anything else.
Maybe tell us a little bit what the numbers are now on LlamaLend, and let's move slowly to Vyper USD. When we recorded the podcast, it still didn't exist, as I recall.
No, Vyper USD has existed since about May 2023.
Okay, then that means Vyper USD didn't exist, I guess.
Vyper USD didn't exist, all right. If I'm not mistaken, on DeFi Llama, it shows that the lending market's TVL is around 150 million, but there is also, of course, the mint of Vyper USD, which has the same TVL. Basically, what was important for Vyper USD, it was to do savings Vyper USD. The savings Vyper USD is such a revenue stablecoin, where the system where mints Vyper USD shares interest with those who deposit Vyper USD there. Why is this important? The thing is that before it was made, very often there was a situation that people very suddenly wanted to borrow Vyper USD. The interest rate increased and it lost a peg to 0.5%, but quite a lot. This, of course, kept it from growing. That's because there was no quick connection, namely supply sync, and savings Vyper USD makes that connection. That is, if people suddenly run to borrow Vyper USD, for example, interest rates in the market have increased for some reason or something else, then the system starts to share these interest rates with savings Vyper USD. People start put money into it to earn this interest, and for this purpose, of course, they buy Vyper USD. And then its peg becomes better and the interest rate falls a little bit. If it falls a little, then more people will borrow it. And the peg accordingly doesn't deviate anywhere. Since we launched savings Vyper USD, the price of Vyper USD has been ironclad at 1.
As soon as LlamaLend was created, it was clear that this problem would exist and that there would be a depeg to Vyper USD?
Let's say it was immediately clear that a depeg is possible and that there should be no depeg. It was immediately invented a special mechanism. It really helps, but it is, so to speak, even more stable if you make savings Vyper USD. Now the peg is very stable. How big is the return of Vyper USD launched less than a year relative to the market? Understandable. In fact, more or less similar yields are obtained that is comparable to the market. Well, the interest rate on savings Vyper USD is roughly equal to the borrowing rate for mint Vyper USD. Maybe a little less, but sometimes it can be a little more, but usually a little less.
So it turns out he has an internal some orbit time, so it doesn't go to the rate there in some AA to tinker with people?
Well, it doesn't look at the AAA bet, but when people start arbitraging, which they seem to do, it eventually ends up at a bet close to some AAR.
Yeah, that would be my question, that conventionally, clearly arbitrage shocked the Stembeni as there, and the market is going there.
The market is going there, and in principle, the rates now are not very high, but they aren't very small. At one point, the rates were really big. There were a few tenths of percentages. This was observed both with Vyper USD and Ethena. But now the rates are approximately the same everywhere, and even Ethena has rates which more or less equal to the same value.
Am I right to understand that plus or minus, it turns out that this system as if unites into such a big piece of DeFi, which is a structural product that depends on the rates on perp for the most part, including they have some other structural products entered there. And let's say if there starts some recovery in the market, everybody starts to leverage. Accordingly, the rate on Ethena grows. Correspondingly, this rate on Ethena makes people do looping in the Aave and increases the rate on Aave. And immediately, accordingly, people, if suddenly the rate of SRUSD is less at the moment, also pull there. And that's how it all goes away in a big piece now.
That's about right. right. The only thing I've noticed is that when the market is going to go up significantly, the users on Curve, for some reason, a little bit smarter than the market because they start using leverage earlier. Therefore, the rate goes up on Curve a little bit earlier than the rest of the market. Maybe because Curve is a fairly complex product to use now, and it is used by more literate people who have a better vision of where the market will move. So it can be used as an indicator, I guess.
I was thinking when you started talking about it that Curve gives you the opportunity of leverage.
Of course, what is good to use a leverage on Curve, that is you can, for example, with fairly conservative parameters to take possible maxima under, for example, Bitcoin. Let's say you chose conservative parameters, then you have LTV is not 90%, which is our maximum, but let's say 70%. But if Bitcoin goes down a bit, you will lose very little in soft liquidation. And then let's say you know that it will go up, it so to speak fell, then went up, then fell, then went up, and you can borrow up to the edge. And then when it falls, you will not be liquidated because your liquidations are reversible and you will survive these falls. Well, you'll pay into them. There might be some fraction of a percent in each fall. But if the Bitcoin is going up while doing so and you know that it will go up on average, that's a good strategy. But apparently some users understood the strategy, and at the moment they're apparently not trying to do that because the Bitcoin is not going up.
Let's maybe touch on where all that money is going. There are some products out there right now. What's the business model for those products? LlamaLend, USD?
In fact, everything revolves around USD. USD means, and the interest on the loans goes to Curve DAO. That is for VEC holders that interest goes to.
All 100%.
Actually, not 100% because part goes for savings USD. So what is separated for savings USD is somewhere in the 20%. And the remaining 80%, they go to Curve DAO and are paid out to users LlamaLend.
As a trickier thing, LlamaLend doesn't really have an admin commission, but it uses USD. And when users add USD in there, LlamaLend serves as this supply sink for USD. If USD holds more, that's the space to borrow becomes more. And in fact, LlamaLend increases the volumes that can be reasonably borrowed when the people mint USD, and there the system already earns.
And going back to LlamaLend, I wanted to ask that the foundation of this LlamaLend, which is called Curve Lend, but I keep calling it LlamaLend, are the Curve pools. So all these transitions, liquidations under the skin happens through Curve pools.
No, not necessarily. That's specifically MM doing that there. And all these soft liquidations, ID liquidations, arbitrageurs do them. Arbitrageurs can arbitrate with absolutely anything. They can arbitrage with Curve, with Uniswap, with Binance.
The second question about the LlamaLend I had on DeFi Llama on March 21 written resupply launch, after which TVL starts to grow.
Yes, resupply. It's a project done, I understand, together with Convex and Yearn, sort of a successor to Prism in a way. But it's not made by the people who made Prism, but rather by the people who invested in Prism. That is, the Prism itself didn't really work. They decided that something needed to be done because they were big holders. And they made the stablecoin intended for farming Curve pools and also for farming lending markets. And it turned out to work pretty well. And in fact, this resupply very increased the Curve's lending market.
Can you explain, please, what's the idea here? I mean, is this some sort of yield aggregator or what's going on?
I understand the idea is basically to farm stable sources of return with leverage, but they made it similar to the work for Prism in a sense, that it's like fork liquidity, they are the same mechanisms, but basically it works fine for farm.
Super. Now, maybe we are going to the ecosystem. What's been happening with the ecosystem in a year and a half? What do you think is interesting for users who are in the ecosystem to pay attention to? What products are new?
I would say that the most interesting thing that hasn't really appeared yet, but will appear very soon, is products that will use upgrades to crypto pools, and we're working on them now. These updates can help make the efficiency of crypto pools much higher. So how do crypto pools work in general? They have concentrated liquidity on Curve, but this concentrated liquidity is managed automatically. And the crypto pools themselves have impermanent loss, more or less like the Uniswap V2. But at the same time, they have concentrated liquidity, so they earn a little bit more. This management of concentrated liquidity, it spends some money. And the money that it spends is now at least taken from the commissions that the pool earns. But that doesn't always work well, because it could be that we have some coin that can change the price. And it changed sharply, and let's say the concentrated liquidity stayed in some place and the price went somewhere here. And then it will turn out that it is quite expensive to move this concentrated liquidity to the new price, and we're in the place where liquidity is not concentrated. We earn little at this point. And here it would be nice to make some investments, so to speak, in the efficiency of the pool, but the pool did not allow us to do this. So in order for it to allow to do this, we're working on updates. What is it and where does it lead? It will lead to the fact that, first of all, pools for the exchange of non-dollar currencies will become much more efficient. For example, euro to dollar or something else, some other currencies, or even gold to the dollar and back. That's actually quite on topic, because now somehow this need for non-dollar stablecoins is starting to become popular. But the current mechanisms to do liquidity, they are not very efficient for them. That is, in principle, can be done manually, but that it will be profitable, it's not very clear. And with such pools, it is much more clear that it can be both profitable, efficient, and liquid to do. And of course, the new project I'm doing, yieldbasis, which does liquidity for the major cryptocurrencies, especially Bitcoin, without impermanent loss, it's also based on this crypto pools update. So it's a very such an important update, but it hasn't been released yet. It will be released in the very near future.
How will it happen, the update? Are all the pools going to migrate?
They don't have to migrate. This update applies to newly created pools. So those pools that exist, they continue to exist, they are not being updated. But the new pools that are created, they'll be able to have that opportunity. So you can create pools that can work much more efficiently.
I see. Before we move on to yieldbasis, I wanted to ask one more thing. If I'm not mistaken, just after our podcast of the past, there was a big reduction in the issuance of CRVs. I think it was severely reduced already.
I think it was It's actually not that it's been severely reduced. It's only been reduced by 15% every year. But what has really shrunk, all the vestings have stopped. That is, the last vestings ended just in August 2024. And after August 2024, in addition to the planned 15% reduction issuance, all the vestings stopped too. So if the vestings count as issuance, then sure, you could say that issuance dropped a lot. But if vestings are not counted as issuance, then the emission has fallen by 15%, but vestings are not happening anymore either.
Has this had a big impact at all on the ecosystem and the market for bribes, CRVC ecosystem? Or did it happen quietly enough?
Well, calmly enough, I would say. That is, the bribe market that exists, it is used, it is quite alive. I mean, some of the bribes, in fact, I paid myself for the main pools from the CRVs that I was managing. Well, I stopped getting CRV. Accordingly, I stopped buying votes. Well, I stopped buying votes, there were new buyers of votes. So the market had found itself.
Well, let's move on then to the topic, which is probably of interest to everyone. Not so long ago, I think it was less than a month ago, there was a white paper of a new project, yieldbasis. As you said, it's something about markets without impermanent loss. Can you dive a little bit into how this works, where impermanent loss goes? First of all, yes, really, let's start with what impermanent loss is, I guess, for you.
Yeah, where it actually comes from. Yeah, that's impermanent loss. I would say is such a thing. Imagine you've got, I don't know, you want to make money on exchanges between Ether and stablecoin and the USD. And so you've loaded the same amount of Ether and USD into a pool. Well, for simplicity, the pool is like Uniswap 2, but it doesn't matter which one. What happens? When the price changes, the price in the pool initially has not changed, but in the external market, it has changed. Therefore, it becomes profitable to buy in the pool. Someone buys Ether in this pool, as a result of which this pool sells the Ether that is going up in price and buys the dollar that is not going up in price. So it is a rebalancing, so to speak. And vice versa, if our Ether falls, the pool buys more Ether at the expense of the dollars it has. It's roughly like that. So pools, they more or less are a rebalancing strategy. But such a strategy has a problem. If we sell an asset that goes up in price, then when it goes up in price more, we have less of that asset than we held, and as a result, we are missing out on some benefit. And vice versa, if Ether falls, and as it falls, we bought it with Ether in USD, then when it falls even more, the bags that we accumulated, they will fall together with Ether, right? That's the result of the pool. And it's growing slower than Ether, for example, right? Or than even a 50-50 portfolio of Ether and USD. And it falls faster than that 50-50 Ether and USD portfolio. And as a result, it turns out that holding Ether and USD that do nothing is more profitable than putting them in a pool. Sure, in a pool, you still earn commissions, but those commissions usually don't cover the difference between doing nothing and being in a pool. And it turns out that doing nothing and just holding crypto is more profitable now than putting them in a pool. And this in principle applies not only to Uniswap v2, but it applies to Uniswap v3 and v4. And you can, of course, manage liquidity that this impermanent loss is not there, but it's a very difficult thing to do. I was talking to professional market makers. The only way they were able to really on the Uniswap v3 make profits, they hedge their positions with options. They manage that all the time. That is, they change the position that makes a hedge. And maybe in the best case, they manage to 10% annualized profits there. But it was very difficult because they don't do it in general usually. Well, of course, if the protocol itself pays some incentives for this crypto liquidity, then people add the liquidity in to farm these incentives. But when these incentives run out, they don't add there anymore. That's the problem with impermanent loss. But generally speaking, impermanent loss is not something you leave to arbitrageurs, for example. So it's not a loss, it's just that when you add into the pool, you have another asset in your hands. That is, if you add Ether and USD into the pool, you are not holding Ether and USD, but something average. And this average, it actually has a price, but not average between Ether and USD, and has a price something like the square root of the price of Ether. And it's not a very nice thing actually for those who add assets into the pool because they want to hold Ether or dollar or Bitcoin and not something so average, not so non-linear. And there are those who don't care. They add into pool and decided that, okay, we hold not Bitcoin, not Ether, but this is such an incomprehensible thing which has its own price. We look at the price of the LP token in the pool and we know how it has historically changed, and it's like the new crypto. But that viewpoint is not very popular. Most liquidity providers don't support this viewpoint, and so this kind of passive addition of liquidity into current AMM doesn't really work. But as I said, it's a property of the strategy itself. It's not that you lose it. That's why that impermanent loss is reversible, because when the price changes back, you get that back. So in reality, that loss is essentially gone. So you can construct some position that allows you to get rid of it. And that's actually what I'm doing at yieldbasis. The thing is, as I said, the price of liquidity is proportional to the square root of the asset price. And I had an idea, is it possible to make a position whose price is the square of the price of what you put in it? And it turns out it is possible. This position is such a leverage. But it's not just a leverage, it's a compounding leverage. What is this, the compounding leverage? Let's say we want to leverage X2. What do we do for that? We add some collateral, borrow under this collateral, and use what we borrowed to buy more of this collateral. And the result is that the size of the loan is half the size of the collateral. Then we have a leverage X2. And what is the compounding leverage? It is if suddenly this collateral, for example, has grown, but our loan remains the same. That is, we then borrow a little more and buy a little more of this collateral to make this leverage up to 2 again. So that the ratio of the value of collateral to loan is 2 again. And vice versa, if suddenly the collateral falls, it turns out that our debt is too big, we need to pay off part of it. We take a part of collateral and pay off some of that debt. As a result of the collateral value to loan ratio, the debt turns out to be 2. We use liquidity as collateral. The liquidity between, for example, Bitcoin and a dollar, in the case of yieldbasis, at least first, would be between WBTC and stablecoin. And such liquidity has value proportional to the square root of the Bitcoin price. When we make such compounding leverage, then this square root will be proportional simply to the Bitcoin price. And as a result, all this liquidity and yield basis will be proportional to the Bitcoin price, but at the same time will earn on commissions. Well, of course, it's not quite that simple because there are natural sources of loss there. These are the same losses as in reversible liquidation in LlamaLend. And the trick is for the pool to earn more than those losses. And it turns out that the Curve's crypto pools can earn more and cover these volatility losses.
Here, we advise our listeners to take a look at Mikhail's report in Belgrade as he shows how yield basis will work on the graphs. When I listened to this report, I immediately had a few questions. One of the things that was mentioned there, now we didn't mention it, if this was all on Uniswap v2, then these liquidity distribution losses were equal to the commission return.
Yeah, that's interesting. I honestly can't answer that question, why that was the case in the simulation. I found that to be a rather interesting coincidence, that if we take pools that have a fundamental impermanent loss, like Uniswap v2, then we apply an algorithm that is essentially anti-Uniswap v2. The impermanent loss disappears, but all the return is also lost. That was such an interesting observation.
Now let's move then maybe to the backtests that were how much will it earn and what will it earn in general? What's the original plan now for the yield basis and what roughly to expect returns on it, and are there risks of loss?
That's a good question. In general, I think that it is quite possible to expect returns between 10 and 20% on average per year. But are there risks of loss? Maybe a small decline in profitability, maximum of several percent. I can't say that I've seen them in the most recent time, but in certain cases in the market, they've been observed, let's say 2%. And I try to adjust the parameters of the pools so that the reduction of the yield is as much as possible absent.
Again, what's inside all this? Leverage means always a lending. Where do we borrow under this asset? Are we borrowing this on LlamaLend, or is it a separate mechanism of some sort made specifically?
It's a separate market that Curve will allocate CRVUSD to. It will be like LlamaLend. The difference here is that in LlamaLend, or for example in the Uniswap v3, the liquidity that is used for reversible liquidations, it is divided into pieces. And here it is at all prices present as an ordinary AMM, like the Uniswap v2. So this liquidity is from infinity to infinity. And so this process of deliquidation is equivalent to the process of preserving this leverage.
And I have this observation question related to the general nature of exchanges. I understand the exchange of one asset for a similar asset. This is what the Curve was initially. And I understand the user flow of such exchanges because it's a frequent enough scenario as it can be stimulated by DeFi protocols. But in general, we can say that a large organic volume is accounted for by exchanges of one asset for another. On the other hand, exchanges of dissimilar assets, they are always related to some kind of speculation, well, more often related to exposure. And as it seems to me, the user flow of such exchanges, it is immaterial. And essentially, those who add liquidity, they don't receive additional rewards and they go to arbitrage. Perhaps because of this commission's reward is comparable to how if we want to use the hedge stroke into Uniswap. That is, there is no place in the market for some such exchanges that create.
It's not quite like that. I've noticed that if you have concentrated liquidity, the return from these exchanges exceed the losses. But in order for concentrated liquidity to work effectively, you need the asset to more or less return to price, to some kind of trend. So it's kind of volatile, but not too volatile. And Bitcoin, Ether, and those major assets, they actually are like that. So the price is more or less back to some kind of trend line. But some meme coins, especially new meme coins, their price is somehow closer to random, and you can't earn on them that way. Interesting observation I tried to simulate for BNB. At some point in 2021, BNB would not earn anything in this strategy, and concentrated liquidity would not work well for it. But after BNB's price went up quite a bit, then it somehow stabilized. Maybe the market maker started working seriously, maybe it just had more adoption. That is, there was this transition of an asset from highly volatile to some calmer one, and then the same algorithm as in yield basis becomes profitable. I would not say that there is nowhere to take a profit, but it happens when there is a certain return of the asset to the trend line.
So basically, we take the risk that the asset returns to some sort of average, and we pay part of the return to the arbitrageurs for executing our strategy.
Yes, although I think that most of what we pay is not to the arbitrageurs. It's still kind of going to the market. But arbitrageurs also get, of course.
Well, by arbitrageurs, I mean, of course, node operators.
Of course, arbitrageurs are such a cumulative phenomenon. Moreover, nowadays, node operators are actually paid a lot of profit. Very often I notice that arbitrage bots pay 100% of the profit to the nodes, and the nodes then share what paid them as a commission back, 50%, for example.
I'm not saying, but it's probably that the bundles are structured now.
Yes, now many EVV operators like this. Sometimes they do it without even asking. One arbitrageur wrote to me surprised when they got Ether from a node operator. They didn't understand where it came from.
I would like to discuss the math that is in the yield basis, despite the fact that when we make a square and under the root, in the end, it turns out that our profit comes from the commission. The commission is 1 + 2 times vector.
This is a rough formula just purely for understanding, because if you make a simulation, then there will be differences.
Yes, it would seem that it would be good for us to have more fees and more fees at volatility, but we start to have more costs at volatility.
Both are growing, that's right.
And from the BNB simulations that you just talked about, it turns out that yield basis is profitable on a less volatile market.
Not exactly. When volatility on Bitcoin falls, for example, that's not good either. It is good when the asset is, let's say, quite popular, when the market is volatile, but this asset is stable. And in principle, for all major crypto, it is so. Also, when the bear market, nobody is interested in anything, then in this situation, you earn less. And when the market is volatile, then more.
So it's desirable for it to go, but come back?
Yes, yes. There was just apparently such a problem with BNB until the mid-2021 that it went and didn't come back.
I think we have a major cost of moving liquidity. And if the market goes, we move liquidity back and forth.
Yeah, but if we have an asset that shakes, we don't necessarily have to move liquidity around a lot. Maybe we don't move it much, but we still earn on the commissions. But if, let's say, the asset just goes up without losses of earnings, for example, or goes down without increasing smoothly, then it turns out that we do not earn on these fluctuations, but we still need to move the liquidity, and that's when you get problems.
I will expand my remark that speculative interest in an asset, or what Mikhail now called an interest in asset for the market, or what I call the percentage of user speculative interest, namely user exchanges, is high relative to arbitrage. This is such a key condition of profitable farming and pools. And for example, against the background of the Solana frenzy, this was very well noticeable that as mem token fluctuated there, then somewhere flew away, came back, but due to very abnormally high speculative interest from the users, created this value which was transferred to the liquidity providers. And on the major assets, for example, wrapped Bitcoin, Ether, BNB, there is not as much speculative interest as we would like, but apparently there is still enough of it.
There's still plenty of it. The thing is that this speculative interest, let's say, it still earns more than these losses on liquidity movement. And strangely enough, it works quite well with major assets like Bitcoin. That is not that their volatility is too large, just that their losses are much smaller. Mem coins are very volatile, but their losses are also very large. And in general, if you remove impermanent loss, then you will not earn much. But in principle, it is possible, of course, for mem coins such a method can be used. It just will not earn, it will be interesting just for market makers and for those who launch this mem coin.
Well, just for information, income on liquidity in mem tokens when selecting conditions is a working thing. I don't know how right now.
I don't know right now, yeah. Of course, when the most frenzy happens, there probably should be something there, especially with the dynamic commission, which by the way appeared on Curve first. But here mem coins on Solana, I think it was applied quite well.
Why am I saying all this? It was interesting to think about how to induce speculative interest on DEXs.
It is not really important that it is on the DEXs. The main thing is that there is volatility of the asset itself. That is, all the simulations that I do within, they all simulate arbitrage. Arbitrage, for example, with exchanges or with other DEXs, but it is arbitrage. So if there is any demand on top of arbitrage, it's not accounted for. It's such a conservative approach. Well, of course, it is good when there is one, but you should not count on it. And as practice shows, if this approach conservative, it is actually very close to the truth. That is, simulations and real profits and pools converge very well.
I understood that in principle, it turns out that you can then, when yield basis is launched, make something like pump fun, but on yield basis.
Well, it is possible, of course, but it should be done as a separate thing because you never know what risks there are. I haven't thought very deeply about what risks there will be with these kinds of coins. With basic coins like Bitcoin, everything is clear, everything is very safe. But with mem coins, for example, I don't know, you have to think about it.
The question I have is why this time chose Bitcoin as the asset and not, let's say, Ethereum?
But actually, Ethereum will be used for this too. But Bitcoin looks more interesting for two reasons. First, the price of asset. It somehow works better in terms of the balance of income and losses. This income minus losses, it turns out to be consistently more than zero. That is, there are practically no losses of the part income. With Ether, it is a bit more difficult. For example, in simulations, rather noticeable the losses of the part income, which is difficult to remove, was noticeable during the collapse of FTX. And with Bitcoin, no such prices change was noticeable. Of course, the price of the Bitcoin dropped too, but Bitcoin was actually shaken much less, in a bad way, than Ether. Bitcoin seems like such a more reliable asset.
What was the percent loss on Ether in the yield basis simulations at this point?
Percentage 3, so it's not that bad.
Well, yeah, not that bad. I thought there would be maybe 7 or 8%, something like that.
But basically, black swans, they can do that via dApps. That's why it's better to have an asset that is quite resistant to black swans. And Bitcoin is a good fit in this regard, although Ether is not bad either. And the second thing is that yield on Ether, we still have, for example, sticking restaking. And yield on Bitcoin is fundamentally absent. There are, of course, things like pawn shop Bitcoin restaking, but this topic isn't very developed and it's sponsored from the printing press. As a result, the yield on Bitcoin now that can be found is quite small. And the Bitcoins which are looking for profitability in general enough. So there is a market opportunity here too. So it seems right to start with yield on Bitcoin. But also it's interesting that on CRVUSD, the most popular yield is tokenized Bitcoin.
This is not surprising. The lend Bitcoin borrow CRVUSD strategy is very good.
Well, apparently they're looking for yield on Bitcoin, so it all points to the same thing.
Well, yes, such a strategy even for Ether is beating it by a head, and the market conditions of the last 2 years beats returns for sure.
Yes, of course it also makes sense for Ether, but for Bitcoin it makes sense apparently. Well, for example, there was a news recently that one of the centralized exchanges has provided a stunning yield on Bitcoin, 1%.
Офігеться, but can be survivable the way to Bitcoin be produced also, but from the Офігеться, but там росточив котмисл до щось інкапевносинді.
I've heard that Coinbase has cards that interact with Bitcoin.
The Eno podcast I was thinking about that it turns out that yield basis is such a structured product.
Yeah, you could say that. Well, basically the same method can be used to do yield per dollar, for example. Ethena does pretty well, and on the Bitcoin is not. But it is also good to understand where the limits on how much this yield can be. That is, in the case of Ethena, the limits on this yield are taken from how big this imbalance of open interest. But on what yield basis does, this limit is where liquidity starts to increase. That is, if the liquidity added in yield basis starts to suppress the volatility of the crypto due to the fact that there is a lot of it, then yield will fall. And the limit is there somewhere. I've been trying to access how much it is, probably around a few tens billion %, will start to decrease due to the impact of the yield basis itself on the market. But before that, you can scale.
It would be interesting if the product captured a few more billions from the liquidity market.
It is interesting, we'll see.
Could you tell us about the yield basis itself? That is, there is any investment in the project, how the economy is organized, it will have the own token. Will there be some payments in the Curve system?
Yes, there's investment in the project. I did a small round, $5 NP, in which filled up pretty quickly and went a little bit beyond limits. There's going to be a very interesting update in the tokenomics, the most important part of it. The update is this. On Curve, for example, incentives are now paid to everyone who add and use the stacking of liquidity. That is, those who stacked on Curve get both commissions from pool, at least part of them, and incentives in the form of CRV. And here there will be a separation. If you didn't stack, you get system commissions, commissions from exchanges, and if you stacked, you don't get get commissions from exchanges, you only get incentives. So you choose to earn YB token or earn the real yield of the system, but not two things at the same time. Due to this, the real yield of those who didn't stack will increase, because those who stack, they don't take this yield. As a result, it will become more convenient to integrate like collateral into different lending platforms. And on the other hand, if someone wants to hold a YB token, then he will probably want to earn in the YB token. And if someone wants to earn not YB token, but wants to earn hard money, for example, Bitcoin, he can choose to earn hard money and he will not need to sell YB token in this way. So as a result, the pressure on the token will be less due to farming.
The YB token get liquid here in rewards.
Yes, of course.
It turns out that there will always be some balance.
Yes, there will always be a balance. And there are some interesting points. For example, the admin commission, it is dynamic and depends on how many % is staked to earn YB token. The sense is this. Imagine that you have absolutely 100% of users for some reason decided to stack to earn YB token. Then it turns out that none of them wants to earn commissions. These commissions have to go somewhere. So they will go to the admin commission, all 100%. If they don't stack the 100% to earn YB token, then it is clear that the most part of the commission goes to those who want to earn real yield. And there is also a part of admin fees. I think it's going to change depending on the state of the market.
And admin fees changes in what range? From 0 to 100?
Not from 0, from some minimum. I'm thinking somewhere around 10%.
And the maximum of 100?
Maximum 100, but when everyone is staked.
The question here then is a logical one. What is the use of the token? And what will be the name of the token if it is already defined?
The name of the token will be YB, and its application will be respectively for managing the system parameters and for earning commissions that the system earns. Just like CRV, and it starts to acquire this feature only when you stack it. So there will be V tokenomics and VYB.
You can also lock it for 2 years?
No, the same as the CRV for a maximum of 4 years. There are some things I want to do. For example, due to the upgrade of Ether, there is no need to ban contracts to lock tokens already. Basically, now everybody can lock it, and you can also send your position, but you can only send it if you lock it for the maximum time. And you can also send multiple positions, but they must be locked for the maximum time to be sent.
What was the problem before with doing that now?
It wasn't that there was a problem, but if they started tokenizing VCRV and selling them, then it would lead to the fact that you could vote for something not good in the system and then sell your position. That is, he heard and came out, maybe he made some short-term profit and came out and sold your position. But as practice shows, that tokenization of locked positions, which did happen, it does not lead to such consequences. And as a rule, you cannot directly make a very big vote and then sell a lot, because your liquidity for these wrappers is actually quite small. Let's just say that when you have a token that is locking, even if you can do secondary tokenization, the opportunity to exit that position, if it's large, is limited. That's why it's not really a security issue for the system.
I have a question about the fact that there is not some kind of contradiction here, that on the one hand we are locking and on the other hand we have an opportunity to sell.
Yes, there is some contradiction here, but I would say that if you're locking, you have a limited opportunity to sell. Well, first of all, you can't sell a little bit, so you can't split your position, so you can move it completely. Secondly, I make the case that it has to be locked in max before you can move it, so you have to sell at a discount anyway, and the discount is quite substantial, and if you're going to sell quite a lot, then it's quite large. That is, the liquidity of the locked token or some secondary token like CVXCRV or SDCRV is significantly less than the main token, so you won't sell much. If you're making some decisions on voting, in the case of CRV, for example, even if you can secondarily try to sell it somehow, you are still making the same decisions as if you couldn't sell it in any way. Basically, you can even now sell the wallet. That is, you can lock on the wallet and physically sell the private key. Of course, it's better that the buyer trusts you if it's corporate, but it is in principle solvable. But still, there will be a discount, still it's complicated, still you will not expect to sell it.
From the technical questions, is this going to be realized as an NFT in these positions?
Yes, I'm making them as NFT, basically, at work. Well, the kind of NFT that can be sent not always, but under certain conditions when you're locked to max, for example.
Who's going to ensure it then when CRV happens conditionally, when there were these liquidity locks and so on, were these individual projects and they were responsible for themselves?
Yes, there will be also liquid lockers.
But they are responsible for their own liquidity there, and here it already turns out to be native.
There is no native liquidity here. They will be responsible for their own liquidity here too.
Then you go to OpenSea and put your position?
Well, I don't think they're going to be traded on OpenSea, to be honest. I think the NFT will be used for what? Only to merge your own positions, for example. Or you want to move your own position to your own other wallet. That's quite a nice use case, actually. And for most people, liquid lockers will probably work just as CRV.
I don't think that tokenized positions will trade.
I think they will trade these wrappers from StakeDAO, Convex.
But when you were talking about all this, it seemed to me that you're just missing a need for Convex.
No, it's not missing, because it's much harder to sell a locked position to max than a wrapper that is liquid and earns. It's just that this wrapper is kind of a little bit like crypto itself. There's absolutely always a demand for it. And NFT, they're only if you find some special buyer. So the number of those buyers for whole large positions is very limited. Most likely, if it will happen, then it will be OTC. But I don't think that it will be massive. With wrappers, it's happening on a mass basis.
Another question, why would I merge two NFT if it prevents me from selling them later?
You don't have to merge them. Moving them to another wallet makes sense. Let's say you decide to change wallet for some reason. For example, you think your wallet might not be safe. Let's say it was a software wallet and you want to move to a hardware wallet. Or you want to move to multisig that you own. And that can be done. And this is actually the most basic use case for this NFT, because most of the questions about whether it is possible to move VCRV.
When we move to the connection with the Curve ecosystem, will yieldbasis somehow be connected to the Curve ecosystem directly? What products will receive from it?
Yieldbasis will be linked to the Curve ecosystem necessarily. First of all, the Curve ecosystem provides to yieldbasis the opportunity to mint CRVUSD. And for mint CRVUSD, the Curve ecosystem needs something in return. First is the allocation of YB token. This allocation of YB token will be, I think, the most effective thing is not to give it out to everybody, but to use it as something to buy votes for pools that have CRVUSD, like CRVUSD USDT or CRVUSD USDC and the like. This token could go as bribes for votes for those pools.
Why these pools?
Because if you vote for those pools, then that increases the liquidity of CRVUSD, and that's good for yield basis. Because the more liquidity of CRVUSD, the better the pair works to CRVUSD in yield basis. That's first of all. Second, if it goes like bribes for votes, those who vote, they get those bribes as income. And third, if it goes for pools with CRVUSD, then it creates an additional supply sink for CRVUSD, which means people will be able to borrow more CRVUSD, and the system as a whole will earn more that way. And fourthly, since arbitrage will take place between markets that do not have CRVUSD, such as Binance, for example, CRVUSD itself will be exchanged for something else, for USDT, for example. This means that during this exchange, pools between CRVUSD and USDT or USDC will earn commissions, which will also go to DAO. As a result, it turns out that DAO will earn bribes from YB tokens, and earn due to the fact that capacity of the CRVUSD system will increase, and also in commissions from the stablecoin pools with CRVUSD.
And there won't be any direct rewards from YB to VCRV?
No, not direct. Well, those kind of just like bribes. Of course, it would be possible to distribute YB tokens directly, but I think it is less efficient. The system will earn more if you do an indirect way. That seems more appealing to me as a VCRV holder.
Yeah, it's interesting here that you're a big VCRV holder yourself, so surely you have plans to make so that VCRV holders will get a benefit.
Yes, I don't want to offend myself.
Then let's move on to the launch plans. Is there any kind of timeline for when this will happen, and what's the procedure? How do you see the launch now? What will be the procedure for launching the project?
I mean, there will be a very short time between the launch of the system and the launch of the token, because in principle, both are ready practically. And yield basis has already passed the several audits, and some audits remain. I'm still finalizing some adjustments to the audits, especially for DAO. And in principle, then we will be able to launch it. We are very close.
Since we've moved on to audits, the first thing I'd like to know is whether you wrote all the code yourself. And secondly, I hear from the answer that some part of the code was definitely written by you. The code is written again in Vyper, or some part of the code is written in Solidity?
No, the code is all written in Vyper, and it's all written by me. But also the crypto pool update will be used here, which is already written not by me inside Curve, but also in Vyper.
How much of a problem is it to find auditors for Vyper?
Not really a big problem. There are quite enough auditors who understand Vyper right now. There are some very good auditors. There are those that are not so good. But in general, you can find auditors for any required price and quality.
A question about Vyper. We all remember that there was a nasty incident about Vyper, its version of 1, and it is not secret. Now the Vyper ecosystem has changed for the better?
Very much changed, yes. The thing is, when the incident happened, then Vyper wasn't even fully audited by anyone. Now Vyper is audited regularly. And not just current versions, but past versions as well. And Vyper is now getting some support from the Ethereum Foundation. Until this year, it wasn't that. The Ethereum Foundation is now finally getting a participation. Not that it is directly helping to develop Vyper, but it is already giving some material and moral support. Vyper is not something that Ethereum Foundation doesn't like for some reason. Well, and finally, Vitalik remembered about that it was he who invented Vyper, and apparently his efforts made it a little bit in advance to the Ethereum Foundation. And in general, I watch how Solidity is being developed and how Vyper is being developed, and I have the impression that Vyper is now perhaps in a better condition than Solidity.
Why?
Because with the development of Vyper, everything has become much better, I would say.
And who is doing Vyper development now? Is it a separate team?
Yes, it's a separate team. It existed before that. It's just that the Ethereum Foundation is more supportive now than ever before.
And coming back, why is Vyper better than Solidity?
Well, I just think that somehow it is written more literate. In Solidity, there is, say, a technical debt that would be nice to fix, but they don't fix it. They just, so to speak, increase in the compiler. And I think even someone from Paradigm Ventures spoke out, or Paradigm Research spoke out about Solidity. That is, they had quite a reasonable criticism about the development of the Solidity compiler, that not everything is good there. And now it looks to me that Vyper is better in this respect. But I'm not a compiler developer myself, so I can't say for sure. It's a little bit of an outsider's view. But Solidity still has those problems that it has innately. There is the stack to deep problem, that is when you have too many local variables, it doesn't want to compile, but you can get around this by using some new intermediate language for compilation, but then you have the possibility of some bugs, plus some obscure bugs can appear. If you use an optimizer, there are periodic fixes. And in principle, the bytecode turns out to be some far from optimal tool. So it looks like Solidity has acquired a lot of technical debt, which has made the code quite large and hard to understand. And it's already quite hard to maintain and hard to refactor. And so it wasn't really done now, and it's a somewhat dangerous situation. And Vyper is much cleaner in that sense.
For those who aren't quite immersed and understand what's going on, what's the technical debt?
Well, I can give here an example that is not related to programming. It is a joke. A physicist and a mathematician are given a problem how to boil a kettle. They are given a kettle, a tap with water and a stove. They give the same solution, pour water into the kettle, turn on the stove, put the kettle with water on the stove. Second task, they are given all the same things, but the kettle is already filled with water. The physicist puts the kettle with water on the stove, turns on the stove. The mathematician pours the water out of the kettle and says that the problem is reduced to the previous one. That's the technical debt. That's when the problem was often reduced to the previous one. I would say this.
A stone suddenly flew into our math vegetable garden.
Well, I'm a physicist, so I sometimes joke about math. Actually, I don't think it really happens that way. But the joke is rather more applicable to code writing than to mathematicians.
Interesting. I think the analogy is great in the sense that we understand how it happens.
It was just easier to make a little bit of some change on top of what was already written to achieve the result. Although if you rewrite and apply more effort, then you'll have better and more understandable code. And if you do that many times, then it turns out you have code that's a big unsupported crocodile. Because they had deadlines, they had to achieve the result as soon as possible. And there was no time to rewrite some pieces. And then we got what we have.
I would like to say in the defense that this is not about such, but about the repeated use of some one fundamental node. And I think that's a good practice, actually.
Of course, it's a good practice, but if the node is very universal, abstracted like library and so on, then it's a good practice.
Well, boiling a kettle is universal enough.
But here we are talking more about some quite insides of the compiler. Yes, by the way, there is a very interesting point there. Both Solidity and Vyper have some intermediate language into which they compile, so it's a language that's not bytecode, but it's not so high level anymore. And Vyper has recently made a new intermediate language, which is still being tested. It's called Venom. Vyper like a snake, Venom like a snake poison, and everything is even cleaner with it, even more optimal, but it is still being tested. Its support can be enabled optionally. And Vyper developers thought what will happen if compile Solidity into this intermediate language, and then the same thing that compiles this intermediate language into bytecode, like Vyper, that is, if Solidity compiles into what is in the middle of the Vyper compilation process, and it turned out to work better. It turns out that the bytecode turns out to be more optimal and less confusing if you first compile into the intermediate language that occurs in the Vyper compilation. So who knows, maybe developing Vyper will do half the refactoring of Solidity inadvertently.
It would be funny if that happened.
But it's completely realistic, that is, it's possible.
It seems logical to me to add some kind of tick when compiling the Solidity code. Which one you want to use?
Yes, that would be logical if they actually tried it. In principle, it's really not that hard to add a compiler, so maybe Ethereum Foundation support here would be very helpful. That is, improve everything for everyone. There is a friendship between Solidity and Vyper wins. One thing I forgot to mention, which is probably related to what's done in Curve. Basically, it was done quite long ago when ServUSD was launched. We didn't like the idea of using centralized oracles. We figured out how to make safe decentralized oracles, and we still use them to this day. And so especially recently, it turns out that they work in many ways better than Chainlink, for example. But Chainlink can actually be fixed to make these aspects work as well. But it turns out that the decentralized oracles based on Curve pools that we've made are very, very safe.
Yeah, I saw a thread about that. Can you dive a little bit deeper, please? How is the price calculation done and what's the difference?
First of all, these oracles are not very fast. They are based on the exponential moving average from the pricing pools. But from what pricing pools? Here, in fact, it matters the most. The price that goes into this averaging system is not the price of trading in the pool, not the price that was exchanged in the pool, but the price of the state. That is the price that appears in the pool after all the exchanges in the block have been made. That is, all exchanges in the block are over, the pool has some price and it goes into averaging. That's what I would call the price of the state. This is very different from Chainlink, because in Chainlink, the average prices of the trading goes with the weight equal to the trading volume, and it doesn't work well with DeFi. This method works well with the order books. That is, order books have buy orders, sell orders. If someone buys, for example, these sell orders disappear. And that's not the case in AMM, because if bought, then these sell orders turned into buy orders. And so the person who bought can immediately sell. And that happens very often in any sandwich attacks on any users and so on. But the problem with sandwich attacks is that these sandwich attacks are trading with a very large change in price. That is, first the price changed up a lot, and then the price changed down a lot. But the trade price of both is the same, and it's very different from the current price. And this price, which is very different from the current price, goes into Chainlink average. And as a result, because of the fact that this price is so different, it also changes the average value that Chainlink reports. As a result, that average value increases, and on some lending platforms, there are liquidations in the right place. Just because somebody made the sandwich attack. I mean, they didn't even think on Chainlink to call something out, but the average price, so to speak, it ruined. If you take the state price in the pool from the end of the block after all the trading took place in the block, then this doesn't happen.
For less advanced users, I would like to clarify that it protects against flash loans. What is happening? You make a loan at the beginning of the block and you must return it at the end of the block.
Well, kind of like that.
If you look at the T block and see that something happened with price, and then it's really impossible to liquidate because the price is in the middle of the block and it's taken at the end of the block and it's going to be plus or minus of the already returned state.
Yes, yes.
So it's such a specially made protection from the flash loans.
Flash loans are not really intended to manipulate the oracle price usually. They just happen in order to do some arbitrage and most likely make a sandwich attack. Because of this activity, such peaks in prices are incomprehensible. We do not meet them in the oracle because these prices are not quite real. They are impossible to arbitrage. That is, this price that is reported by Chainlink that saw the sandwich, it's impossible to sell at that price. That is, let's say the price jumped, but it is impossible to sell at that price because it doesn't exist in reality. It was there, but it was only for a moment, this dubious transaction.
Basically, can be said that Chainlink is good at telling a story, but worse at telling what you can do.
Well, perhaps it does, but really just the methodology of the Chainlink is very well suited to centralized exchanges. On a centralized exchange, the sandwich attack is not possible because your orders after buying just disappear, so they are not. And on decentralized exchanges, they automatically, so to speak, within the same transaction, they already turn into an order of a different type. And this already makes such a methodology of the Chainlink not very applicable. And since the share of DEX, strangely enough, is still growing in total exchanges, then for those assets which mainly live on DEXs, Chainlink has periodically problems. And in principle, it's easy to fix because there is nothing that fundamental. But so far, it's mostly unfixable. But I think they will fix it.
Another thing that I remembered is the multi-chain EVM and the Curve ecosystem in a multi-chain. There are more and more new chains and dApps that use their chains. How does that, in your opinion, affect the Curve? Will there be, let's say, the Curve on Solana or other non-EVM compatible networks. What's your vision for this whole thing?
So far, it's mostly on Ethereum mainnet. Well, about the different chains, sometimes they make sense, but more often they don't make sense. If you're just launching a new chain or a new layer 2, it makes little sense to it. There are certain use cases where it makes sense. For example, when an exchange launches its own chain or layer 2, that is, the exchange wants to decentralize, but to get more yield at the same time. It attracts its users into its chain and earns on it. Coinbase made a lot of money on this, so to speak. BNB chain in principle in the same way, but BNB chain at some point it was abandoned in a certain sense, but then they started again. So it's quite a working story. Also, I guess for some projects, your own chain makes sense. For example, for order book perp DEXs, for the Hyperliquid, your own chain makes sense because they don't need composability. This application just works there. And that's it. Well, you can launch something there, of course, but in general, they are self-sufficient in this sense. But they need fast speed, so they launch their chain specifically for this application. It works well in principle. Layer 2 is the same for the same purposes. For example, the DDX was layer 2 on the Starks, basically. It's a special one. And then it moved to the space ecosystem, I think, for nothing. But still, they're on that chain too. Well, it's basically a use case where its own chain makes sense. For non-financial things too, I think their own chain makes sense, or rather layer 2 makes more sense. For example, Lance is already on its own chain right now.
I honestly don't know about that.
But for all sorts of web stuff that's not financial, probably it's layer 2 makes sense too. But for layer 2 make a lot of sense, you need to get in and out of layer 2 very quickly. And of course, I understand that they are working on it, but so far it is not quite fast. But I think it will be. And Solana is already a separate thing, so to speak. But Solana, of course, is a parallelizable blockchain. There are several of them now. I don't know how much parallelizability adds to fundamental speed. That is, I think the fundamental speed addition there comes at the expense of centralization. It's very centralized in general. But it was just promoted like this, the memcoin casino, very strongly. I don't know if they can make themselves as such a base chain, but now apparently they're thinking about it. Well, in principle, it makes sense to launch something on Solana, but there is the question of how. For example, EVM on Solana. That is either in this way or try to do natively somehow, but this is such essential development. And for Curve, it probably didn't make much sense because Curve is a non-casino project. If Solana starts to move away from the casino, it makes sense to invest maybe in porting Curve to Solana. Well, Aave, by the way, was recently ported to Move, that is the language to deploy on Aptos, as I understand it. Well, it's an even riskier venture than Solana in that sense because it takes a lot of effort, and in fact, adoption of the Aptos probably worse significantly than Solana.
I was wondering too, I saw this news indeed. I can't remember if it's us or India called through. They were even already deployed.
Their development, I'm sure, is pretty much complete for that.
It's kind of an interesting twist.
The thing is, generally speaking, some of these chains, Aptos included, they are willing themselves to invest their own money so that other DeFi protocols port it. I think Aave just took this opportunity. But how good it is in terms of users, I don't know. Technically, of course, these chains are pretty good. I mean, technically, they're parallelizable, more decentralized than Solana, in my opinion. So overall, they are not bad chains, but there are not a lot of users there. But the other question, of course, is how much this parallelizability gives some kind of acceleration, because bottlenecking is not really about parallelism in the Ethereum, but about something else, as I know. The Ethereum can be parallelized too, but so to speak, the biggest accelerations of the network can be obtained not through parallelization, but through some other things. And parallelization, well, it makes sense too, but it makes sense later. So I think that somewhere, well, up to 10,000 TPS, it seems to me you can survive without parallelization.
What do you think the bottlenecks are in the Ethereum?
Well, again, I'm not a blockchain developer, so probably not a great authority in this area. But for example, I asked Andrei Kronch his opinion on this topic because he founded the Phantom and is now already developing Sonic. He said that in his opinion, oddly enough, one of the essential bottlenecks is the database, where the state of Ethereum are stored. And he even suggested to the Ethereum its own contribution, a faster database created to store the state. That can be several times faster. Well, I don't know, but I think that it's available for use. So it's at the client level. It's not even chain architecture, such a simple enhancement. But I understand that there are other improvements, as they say, low-hanging fruit. There is something simple that can be done. Through those things, you can basically, as I understand it, do a certain amount of acceleration.
Well, looking for ideas for a startup, here's where you can get them.
No, if someone writes an alternative client, directly on the alternative client to earn not very much. Because what do client developers earn for the Ethereum? Donations from the Ethereum Foundation? Not very well paid in principle. It's not really a startup idea. It's more like something about open source code in order to write something that's useful for everybody, but not about making money. That's probably why it's not really improved. Although it would seem like it should be very profitable for the Ethereum. So it's supposedly something that the Ethereum Foundation should be investing money in.
As far as I know, these client teams often earn by customizing the needs of your clients to the needs of clients.
Yeah, but that's such a typical story too, how to earn in open source code. For example, Red Hat is the most successful company that earns off the open source code of the Linux kernel. So they make their own distribution that they sell to corporate customers, but mostly they don't earn on that. They make money on support. There are a lot of people who go out to the place, configure something, get money, the company earns all that. But in fact, there are very few companies that could repeat this path, that are successful enough to be able to repeat it. Of course, there are some databases. For example, the Nginx server, it even made an IPO, as I know it's open source code too. It's really hard to earn from open source code. I recently talked with the author of the Snackmate library, and he has very strange license chosen, in my opinion, for his library, because it, let's say, is not suitable for all smart contracts. And I had an idea that I really liked, that he could actually earn on it. That is, he could do dual licensing of the library, and if someone has a license that's incompatible with his, then he can license under another license, but, so to speak, take the money for it and use it to develop his library. But in my opinion, he's selfless, he's working for the good of the whole world, and apparently he's not going to take money for it. And so there is an opportunity. That is, if you make high-quality code that you want and very convenient to integrate into other projects, you can make a double license. One of them is open, but what is called viral, which does not allow commercial use of derivatives, and you can, so to speak, under any license, just commercially license it and take money for it. And it turns out that you can make money by double licensing. It is indeed a working story. Maybe even in the world of smart contracts it is possible. But I have not seen it in the world of smart contracts.
The logical question here is, and what license will yieldbasis have?
Yieldbasis as well as Curve will have the most sensitive algorithms, which are the main difference, the feature of yieldbasis. There will be a proprietary license in the sense that you can read it, the code, but you can't use it. But other things like refactoring, governance, for example, these token things, they, like Curve, will be under an open license.
And the second question that I wanted to ask during the discussion is, how do you see then some fair state of open source code? How to make it, on the one side, it is open, and on the other side, people really get something for their services? I mean, where is this state?
It's a difficult question. I think this question has not yet been answered. But what I mentioned is earnings on support, dual licensing. In principle, I don't know, but where should client modification be used? I mean, the Ethereum client, right? Where you need an Ethereum client modification. Or the Ethereum client, basically, it is not embedded. It doesn't need to be embedded in other software, supposedly. There is also, it would seem that you can't make much money on this business. You can earn money on support, on the fact that to run some nodes, there are some RPC on the basis of this client, that is these services. If the firm that writes a good client also makes a service that makes good RPC, it's already a reasonable story. I guess in this case, this would probably fit, because by the way, I haven't seen any good RPC for Ethereum. They all have some little problem. So there is probably some niche here where you can make money and write a good client.
Just always in such cases, when support is earned, there is a temptation, because there are multi-directional initiatives, and the team, as if there is no sense to describe their code well and make it available, and some documentation, because they just earn on it. So, well, we're not going to describe it very much. Let them come, they pay us money, then we'll tell them what's in the documentation.
Well, there needs to be a balance, because if you describe it badly, then this code will not be popular enough. Yeah, probably a good example is the Nginx web server. In principle, its documentation is described quite well, but nevertheless, the company seems to exist and earns well. But there was actually such another thing that when this web server only appeared, good documentation existed only in Russian. That's why the Russians got some head start.
It's a funny story that there's some still such localized features somewhere.
Well, I think just here too, in the case of Ethereum clients, there are local features. It's possible to do something, but again, I haven't heard of teams that write an Ether client also hosting, for example, RPC and earn on it. So many of these here models earn on open source code. They haven't really been explored in crypto yet.
Super. I think we discussed most topics, and would like to ask one question from our listener that's more philosophical. What's an important truth that very few people share with you? It's a truth for you, but very few agree that it's true.
I'll say about crypto, because it still seems to me that crypto is not a speculative thing, but it is really the future architecture of world finance. But I don't think very many people share that view.
How do you see then the new round with Trump coming in? I know it's hard to answer all CEO and all crypto projects these questions, because you can shoot yourself in the foot. But how do you feel? Is regulation better, or vice versa?
Regulation in some sense, of course, is getting better, definitely. But there is also some bad hyper-speculative momentum that came here. I think it has become better in terms of regulation, but what has got worse is that the abundance of speculative applications of crypto, especially meme coins, it gives people the impression that crypto is a casino. That is, it is said everywhere that crypto is a casino, and there is a lot of money to be made, but a lot of money to be lost. Someone was liquidated for 100 million, and someone made a few tens of millions by investing $1 in Trump's token yesterday. So this all gives the impression of money that can easily appear and easily disappear. But crypto, that's not what it's about, generally speaking. And that impression, I think, is false. And it seems to me that the attempt to give that impression to people, it has somehow intensified with the arrival of Trump. And that's the downside. Well, how the regulation has become better, totally a plus, I think. Well, some members of Trump family, they're trying different things in crypto. There are speculative things. And this World Liberty project, which is much less speculative and much more DeFi, and stablecoins they are launching. So they're trying absolutely everything in crypto. But apparently, because a lot of things were banned and then those bans were canceled, then the speculative part of it started to really bubble up. And until people get tired of the speculative part, they probably won't pay attention to the fundamental part. But sooner or later, it will happen.
So in a way, with the arrival of Trump, you as the founder of several projects already in the crypto became more comfortable sleeping?
Well, basically, I wasn't particularly uneasy about this SEC for the reason that I don't live in the States. If I lived in the States, I would definitely sleep better. But I didn't to be touched by the SEC, so I'm not complaining.
The arms of the US are long enough.
It's not really about the arms themselves, it's that they're setting an example to everybody that here we are doing regulatory relief to have more innovation. Now all the crypto development is going to reach out to us, and the future is going to be built in us. And other countries are going to look at that and think that the future can go directly from our hands to the States, so we need to reduce regulations too to make our climate more attractive. Here I think that mechanism is available. So in that respect, I think it's well.
When we were just talking about regulation and about meme coins being very much promoted in the public media space, I understood that there is another thing that's changed in the Curve ecosystem since our last podcast. Curve has become much, I don't know how centralized it is, that's going to be the question, and that includes comments. I definitely think it's worth noting that Curve has become much more prominent in media and in its, and there is a weekly newsletter.
Yes, yes.
Can we say now, is this really some initiative you have in the media?
Yes, it's not entirely spontaneous. We've started trying to reach users much more than before.
And is it making any significant progress that you can see with the naked eye?
I don't know. It seems to me that it does, but how to measure it is, of course, a question. I think it still needs to be done, yes.
And can you tell me what are some of the conditionally persistent activities in Curve right now? I've already mentioned the newsletter. Is there more? And where to go to read about the Curve ecosystem or Curve as a project?
Well, we in the various communities write all sorts of detailed guides on what to use. So that activity, I would say, has increased. Also, the activity of to make the interface interface more friendly has absolutely intensified inside. The result of that has not yet appeared everywhere in there. That is, it will still appear, but yes, it is there. And I think what's important here is that the average user portrait has changed a little bit. In the early days of DeFi, the user was more or less knowledgeable. That is, users were ready to experiment. They were ready to spend weeks, if not months, learning in depth about how and what to use. And in general, if a product was more effective, it didn't matter at all what it looked like. The main thing was that it was more effective, and then the users will come. I don't think that's quite the case now. Now there are users who are less aware of the risks, and so they are not ready to experiment everywhere, so you need to let them by the hand, that is, to make everything clear to them, to integrate everywhere in places where these new users are. But yeah, I mean, it's a little bit different, so it requires a little bit different approaches.
Great. You are looking for more community where there's news about Curve. In the Curve community, I understand there's chats in Telegram, both in Russian and English.
Sure.
There are newsletters and review pools, which is the most profitable, and just news from the Curve ecosystem. Well, I think plus or minus, we did a review of everything that has happened since the last podcast. Michael, maybe if there's anything to add, now would be a good time.
I think we discussed everything.
Then thank you very much again for coming to talk about what's going on in the crypto world, in your crypto life, to talk about your new project. It's a pleasure to listen to it. I hope that maybe we can get together again sometime when there are some more big new updates.